Gleanings. He is Chris. I am Jesse. And today, Chris, we thought we'd just kind of take a fresh look at the market. We've talked a lot about diversification throughout this year, and the theme continues.
So let's first look at what happens when we get into a rate cutting cycle. And this is all 8 rate cutting cycles since 1984. You know, you hear a lot about how, hey, the Fed cuts rates because the economy's slowing, because they've over-tightened, which they've done some in the past.
They have done, right?
But if you take a look at this since 1984, I mean, there have been 5 non-recessions from a rate-cutting cycle standpoint, which have actually been pretty good. When rates are dropping, stocks tend to go up. There have been 3 recessions because they overcooked it, but it's not the majority of the time.
And this chart from Bloomberg even makes note at the top there about it making that first cut in a non-recessionary environment. It's hard to argue that we're in a recessionary environment right now.
That's right. I mean, GDP was up 2.8%, I think, in the last go-around, which is nice, 2 to 3% growth. I mean, that's good.
Yep.
So the NYSE, interestingly, next chart, has broken out to a new all-time high on the advanced decline line. That means the number of stocks or issues advancing versus the ones declining. I mean, that's a good sign. I will say the NYSE is where you tend to have more industrial type names, more healthcare type names, et cetera, versus the NASDAQ. So, I mean, there is some rotation there that's occurring as well from a financials, healthcare, et cetera. Because tech stocks in the last little bit haven't acted quite as well. And, you know, if you look at the next chart, maybe this is why. You've got multiples, meaning what those stocks trade for the Magnificent Seven, which are substantially higher than the S&P, but also what you have are much cheaper mid and small size companies.
Yeah, as a matter of fact, I kicked it off with continuation of discussion of diversification, and there you see mids and smalls are more attractive from a price standpoint, from a price or earnings valuation standpoint. They look a little bit more attractive. And on this next chart,
and maybe this is why. So the blue line is earnings growth. So on the left, you have large companies, and then mid-sized companies, and then small companies. And by the way, this is probably the most important chart you could look at from a diversification standpoint. So you can see that earnings growth in the last 5 years has been bigger for mid-sized companies and even bigger yet again for small companies. And yet what has happened in that time period is that the valuation change, meaning the price of those stocks relative to earnings, the multiple,
what people are willing to pay for
what you're willing to
stocks,
pay for
right?
it. Large companies has gone up exponentially. But look at mid and small companies. The valuations have actually shrunk.
It's been a drag.
Yeah, absolutely. So, I mean, those companies are understandably cheaper than, the large company brethren. And then look at this next chart. So what you've seen in the last, and this is from Charles Schwab as of about a week ago, if you look at the S&P 500 large companies, the sales beat rate, okay, meaning how many of these companies are beating their sales consistently. In 21 and 22, 85% of these large companies in the S&P 500 were beating their sales targets. And now you're down to about, 55%. So it's going the wrong way. So the big question is all right, well, I mean, should these things trade at accelerated multiples if they're not beating their revenue targets? Now, the one thing we will say is, and we've talked about this the last few weeks, there's been more mention of operational efficiency, right? I mean, it's like Warren Buffett says, you can't, Uncle Warren over your shoulder there, you can't just count out American companies. You can't, because they will continue to manage their costs. They will continue to manage for operational efficiency. So they may not sell as much, or sales may increase.
Yeah, I've heard it said, American CFOs have 200 years of history now to lean into to better understand, hey, that's where they messed it up last time. And so you see that the earnings are still beating, but to your point, a revenue slowdown is not necessarily the most positive thing, especially when you realize you're paying up for those, those companies.
Elevated multiples. That's right. So let's look at the next chart from Fidelity from Yuri and Timmer. And what's interesting is if you look at the S&P, not by market cap. So the top three companies on a market cap basis for the S&P are NVIDIA, Microsoft, and Apple, not in that order. I can't remember who's in front today. But if you take the S&P and equal weight it 1/500th for each company, what you'll see is the average company is breaking out to new all-time highs, and that's a good thing.
Yeah, again, it shows some willingness to buy value, and that these companies aren't bad companies. They've just kind of been left for dead because of the excitement around some of those larger companies.
Yes, specifically more toward the tech side.
Mm-hmm.
But I mean, seeing equal weight and the NYSE advanced decline line break out at the same time implies that you're getting rotation into those more value-oriented sectors, which would only lead you to believe then that small and mid-sized companies, which have gotten way cheaper, have during this, well, I say way cheaper. They've gotten cheaper. Their valuations, what they trade for, have gone down in the last 5 years, even though their earnings have grown faster than their large company brethren. So let's look at this final chart here. The Russell 2000, which is small companies off of 1 year major lows.
Yeah, so going back to that October low of 2023, we're 181, and this is about a week old, but the chart's showing through July 22nd. It's up 33.4% off that low. It's saying out to 250 days, or basically 1 year in the market, is should be up on average around 60. I shouldn't say should be up, but on average it has been up about 60%, which means there's maybe even a catch-up trade here for small caps just to get to the average. Not to say that it has to make the average, but there is reason we're seeing across all these various categories that there's opportunity for small caps to actually make a move here and promoting again diversification.
Right. And of course, we don't know what's going to happen with small companies, but it is pretty interesting that some of the weight of the evidence is kind of picking up here a bit. So
well, again, it's for me, it's we talk about it all the time. Cost is what you pay, value is what you get. Well, if I want to go and if I'm looking to deploy money in one area versus another, I'm probably going to see what the averages are, what the historical record is, and if it's cheap right now, maybe I go and put some dollars into that, and it seems as though money around the markets are favoring those types of decisions right now.
Yes, indeed. We'll see what happens.
Yep.
You watch anything good?
We're into the Olympics with my boys, having done track and field last spring. They know more about those sports now than I ever have, and so we're kind of paying attention to that. What about you?
Yeah, same right now. Other than that, just trying to finish up seats. But yeah, the Olympics is a
2-year adventure for you all.
It is. Man, seats,
You're committed.
God,
No sunk cost for you in that one.
Man, I mean, I don't know how many. There are 8 seasons of this show, and it's like 15 episodes each season.
Oh, wow.
It just goes on and on. Golly. Anyway, thanks as always for watching. We're grateful. Please do click the subscribe button, click the bell to be notified when we post, and we'll see you guys soon.